Good afternoon, everyone, and welcome. My name is Lee Schwartz, and I'm the Director of Business Development here at SVA Certified Public Accountants. Thanks for joining us for today's webinar, Understanding Business Value, Valuation, and Value Drivers. Now, before we get started, I just want to take a minute and say a few words about SVA. For now more than 50 years, SVA has remained an independent CPA and advisory firm serving closely held businesses, family-owned companies, nonprofit organizations, and high net worth individuals. Our vision is simple: to remain independent so we can continue putting our clients first. And one of the things that makes SVA a little different is that we believe that accounting, tax, audit services are really just the foundation. Our real goal is to help business owners make better decisions, improve performance, and plan for the future. So today's webinar is a great example of that philosophy. I'm really excited for our speakers to start talking through some of those strategies with you. But before we dive in, a couple of quick housekeeping items. This webinar is being recorded, and we will try to leave time at the end for questions. Having said that, we have a lot of content, and we only have a half an hour, so forgive us if we don't leave a whole lot of time. But again, please submit those questions using the Q&A or the chat function here in Zoom, and we will get to them if we have time. But let me introduce our speakers today. Joining us are two of our most experienced members from our closely held business team. We've got Nicole or Nikki Grollup and Craig Maternowski. Both Nikki and Craig are principals and work with closely held businesses on all sorts of business issues, including, of course, valuations and helping drive up those valuation numbers. So with that, I will turn things over to Nikki to get us started.
Thanks, Lee. Well, let's jump in today and let's talk about how business valuation works and common misconceptions. So we're going to start on number one of this agenda. So what determines value? A lot of times, if I haven't talked to a business owner that's looking to sell, the first thing I'll ask them is, what's the value of your business? And the first thing I hear from them most often is, I have no idea. So then typically we'll start in on this valuation conversation that we're going to have today. So what is a valuation? It's really to determine what a willing buyer and a willing seller will pay for a business. So you haven't gone to market yet, so you don't know what a willing buyer will pay. So this evaluation process will go through that and determine that. Likely the valuation that you come up with on if you do a full valuation, that's probably not the exact number you're going to close for, but that gets you in the ballpark of where you need to go, where negotiations should go. Financial performance is only one component of that. So a lot of times when I talk to people about valuations, they're telling me all about their numbers, which are great. Your numbers will help lead, but that's only one component of it. And we'll talk about some of the other components. And then essentially buyers are buying future cash flow of the business and they're taking on risk. So a lot of scrutiny will go into what that value is because they want to make sure they're not taking on too much risk and that the future cash flows won't be there in order to pay for the business and provide a return on investment. So during the valuation process, there are three different approaches to use to value a business. The first approach is income approach. So you look at EBITDA, earnings before interest, taxes, depreciation, and amortization, or cash flow. Typically, those two are one in and of itself, and then you take a multiplier on that. The next approach is the market approach. So valuation experts have access to significant market data. Depending on your industry, there might be a lot of market data. I just did a construction company that had substantial market data versus another company that's going to have less market data. And then you take that and you use that helps determine what a capitalization rate is, a multiplier is based on revenue, EBITDA, and multiple different things. And then there's the asset approach. So the asset approach really looks at book value. What's the book value of the business? A lot of times this is used for distressed businesses. So really this is kind of their liquidation value. So most operating companies are valued using the income approach and the market approach. The asset approach always needs to be evaluated, but typically is irrelevant to evaluation. So I want to go over some common misconceptions on what valuations mean. So revenue equals value of the business. Revenue is a component of your value of business, but it does not equal the value of your business. Book value equals business value. So book value is just your equity on your balance sheet equals your business value. And my hope for all businesses that we're talking to today is that your business value is higher than your book value because your business value doesn't factor in any appreciation in any assets or any goodwill or other intangible assets, which are typically present with good operating businesses. Every business in the industry sells for the same multiple. When you have the opportunity to look at that market data, you will quickly realize that that is very untrue. And we'll talk about a lot of factors on why that's not true, where you might have the same business, they might have similar revenues, similar EBITDA, similar cash flow, and they have different multiples. Somebody will pay more because of my hard work. No, because remember, you're buying future or you're selling future cash flows. So that's going to be their hard work. So it needs to be sustainable. Just that a lot of effort went into something doesn't necessarily equate to sustainability. And tax returns alone determine value. Tax returns are typically reported on tax basis, which can be very different than book basis and very different um, than reality, than cash flow. So definitely need to understand we would evaluation process does match it to the tax returns, but that's only one component of evaluation. So let's look at a practical example. So we have a company that has the same revenue, but they have a very different value. So we have two companies here that each have $10 million of revenue. Company A has recurring customers, strong management, and 20% EBITDA. Company B has customer concentration, owner dependence, and 10% EBITDA. So right now, starting off the gate when looking at evaluation, we have $2 million of EBITDA in company A, whereas we have $1 million of EBITDA in company B. So then once we add a multiplier on that, essentially company A is going to be worth double what company B is worth, even though using if they have the same multiplier, even though they have the same amount of revenue. So buyers are really paying for sustainable future earnings, not historical effort. So let's look at some of the key drivers that influence enterprise value. So there's four drivers that I want to focus on today of the multiple. So the multiple is based on your EBITDA. So financial performance. So right there, revenue growth. So if you have stable growing revenue, that's going to add to your multiple. EBITDA margins. So we just looked at a company that had double the EBITDA as a similar company. Well, they're going to get a better multiple, and what they're multiplying by is higher. Consistent profitability, right? You want to make sure. I just looked at a company that the profitability, was it fluctuated dramatically. So I had a lot of questions on what is this fluctuations and how can we predict what it's going to be with these fluctuations? So a lot of questions needs to be asked there. And then quality of earnings. How good are the earnings that you're using? Risk factors. So again, somebody doesn't want to buy a company that has a lot of risk factors. So if there's customer concentration, right, that's going to reduce the multiplier. Supplier concentration. Owner dependence. That's a big one. We've talked about it a lot in this series, and that's how important it is. But that will have a significant impact on the multiplier. And key employee retention. The success of the business relies on your key employees, so really need to focus on that. Business quality, recurring revenue. Recurring revenue is going to have a much higher multiplier than one-time revenue, right? You're always replacing that revenue. So there isn't a value in that replacement stream. Now there is a value in the business, how people are feeling in the marketplace for the business that will increase the multiplier. Deferred diversified customer base. So really, hey, how big is your customer? If we lose one customer, what does that mean to our revenue? Goes along with customer concentration. Strong systems and processes. So does everybody do the same thing, know what to do, know what their roles are? And then competitive advantages. Do you do something that's hard for other businesses to do or other businesses don't do it? That's definitely going to increase your multiple, and that'll help you find a strategic buyer. Growth potentials. So new markets, can you get into new markets? How hard will it be to get into new markets? Scalable operations. What will that look like when you try to do that? Is all your workflow scalable? Organic growth opportunities. With your current customers now, without doing anything, is there a lot of opportunity for organic growth? And strategic expansion. A lot of times I'll have people come to me that they're looking to sell their business and they know that there's a lot of strategic expansions they can do. They're just nearing the end of their career. Well, that's a big selling point when we're looking at selling the business to say, hey, this business is teed up and this is how easy it will be to do that. So you'll see on this list, there are financial numbers on here, but there is a lot of non-financial numbers too um, that have an impact on the multiple. Now let's look at just a practical example. So now our first example looked at, hey, if we have the same revenue but very different EBITDA. Now let's look at if we have the same EBITDA but we have different multiples. So a business generating $2 million of EBITDA, one sold at 4 times multiple, so they sold for $8 million. Another one sold for 6 times multiple at $12 million. Let's say they got to an 8 times multiple, they're best in class. That could be a $16 million sales price. So the same business with the same EBITDA, your sales price could double just based on the different multipliers. So the EBITDA didn't change. It's just what changed within this analysis is the quality of business. So improving business quality increases value more than just increasing revenue alone. A lot of times people will come and think, hey, I need to increase the revenue. And they might increase the revenue in an unhealthy business way, and they're better off not to do that. To increase revenue in a healthy way is always beneficial, but then look at some of those other business aspects that can change the multiplier. So, what are some factors that buyers evaluate when assessing a business? How do they get to know what these should be? So typically, after you have a letter of intent, you would go into a due diligence phase. So that's the phase where the buyer and the seller get to know each other. Typically, the buyer is going to spend more time trying to get to know the seller's business, the business that they're looking to take over. So they're going to do financial diligence. So they're going to potentially do a full quality of earnings or something over earnings to understand, hey, is the EBITDA used in that valuation process, is that accurate? Is that sustainable? Were there one-time revenue items in there? Were there one-time expense items in there? Are there cutoff issues in the financial statements? So a lot of good things looked at there. Working capital. So how does this business run and how much working capital does it need? How much inventory does it need? How much cash does it need at any given time? What do the liabilities look like? Cash flow. So always looking at, you're as a buyer, you're buying future cash flows. So you need to make sure that those cash flows are going to be there. And what debt obligations are there on the books? And then are you going to assume any of that debt? Are you buying the stock? Are you buying the assets of the company? So due diligence can go a little different ways depending on how the transaction is structured. We'll look at operational diligence. What's the management team look like? How stable are they? Is there enough, or is the management team depth good? What sort of systems are used? Are they is it a turnkey kind of business, or are you going to have to make some big changes with systems? Technology, I want to add to this, data security. That's a big thing. So is the technology and the systems up to speed with where they need to be, especially if you're looking for growth and sustainable growth? And what are the processes? If you're looking for this to say, hey, maybe I can open another location soon, are the processes that are currently developed can they be used in future operations at different locations? Commercial diligence. So customer retention. If I buy this business and I can't retain the customers, then I paid for this cash flow that isn't going to be there. So that's a big thing. Market position. How does the market value this business? Competition. How hard is it for other people to start practicing or competing with you in the area? And how many current competitors do you have? And then what's the pipeline? What's the backlog? What's the potential for earnings? Is this business in its infancy stage, or is this business, on the downward slope? Where is this business as far as what that cycle looks like? Legal and tax. So we'll need to look at contracts. Are those assignable? Are they good contracts? Employment matters, right? You want to make sure that you keep the employees that you want. So I need to address that. Compliance and tax exposure. So if you're buying the stock of the business, you're going to do a lot of work over tax exposure, because if there's any tax liabilities, you as a new owner would step into the shoes and need to cover those. Owner transition. So what's the owner's transition plan? What's the management depth around that? And you as a new buyer, or how much impact, or how often and how involved are you going to be? Customer relationships. If those customer relationships are just with one individual or a few individuals, that's not as advantageous. And then retention of key employees. So you want to make sure that your key employees are going to stay. So let's look at another example of which businesses get a higher value. So business A, owner makes every decision, owner signs every check, and owner handles the largest customers. A lot of you will know, like, hey, that's not good, but you really need to look at your business and say, how much decisions am I making? And can I offload any of those decisions? Can I diversify those decisions? Those are going to add to the value of your business dramatically. Business B has a leadership team that operates independently, documented procedures, and customer relationships spread across management. So you want to make your business look like business B. Business B is going to get a higher valuation, so it's less risky. Buyers don't want to take on risk. So as you can see, it isn't just about financial results. There are all these other things that lead to the value of your business. Hand it over to Craig.
Thanks, Nikki. All right, how operational and financial improvements impact value. And for this, we're just going to revisit a common method used to measure small business and closely held business. So we have first recasted or normalized EBITDA times a multiple equals the business value. So if you increase the EBITDA, you increase the business value. If you increase the multiple, you increase the business value. If you increase both, then you increase the value even more. All right, so first we have the financial improvements, and this area improves the EBITDA. So first is to increase the bottom line, and we can do that by increasing top line sales, reducing expenses. Something we like to do a couple years in advance is to reduce any sort of discretionary expenditures, creating a model where we have a predictable cash flow, clean up the balance sheet. Next, we can move on to increasing the multiple, and this would be improving some of the operations, and we can do that by standardizing and documenting the procedures, building that strong management team, which reduces owner dependence. We want to look at concentrations and reducing those in advance, creating a model where we have recurring revenue, allowing for good strategy and not being reactionary. Okay, so the multiple is a range of value. So the higher that you score, the higher the multiple. The lower that you would score, the lower the multiple. Up to 80% of a company's value can be tied up into its intangibles, so it makes sense to work on those in advance. All right, so here's an example of an EBITDA. On the right-hand side, we have the definition, which is earnings before interest, tax, depreciation, amortization. On the left-hand side, we have the sample and simple income statement or profit and loss, where we start with the sales, we reduce it by the cost of goods sold, reduce it by the operating expenses, and we get to our normal bottom line of $409,000. So to this, we adjust it by the EBITDA. That brings us down to 400,000. And then finally, we want to take this EBITDA, we want to recast it. We want to take out things that are maybe not normal. So in this case, we have excess wages of 50,000 along with additional owner benefits that do not need to be there. So our normalized EBITDA is 450,000. So we go from 409 to 450. All right, so let's look at the numbers again. So we looked at that a little bit with Nikki, but I wanted to go over that again. So our baseline here is 500,000 for EBITDA. We're using a multiple of 5 that gives us a company value of $2.5 million. Example 2 is we work on the financials, we work on improving the EBITDA, so we improve that by only $80,000. So now our EBITDA is 580,000. Multiply that by the same 5 multiple, and that brings us to a value of $2.9 million. So increase of 400,000 by simply improving that EBITDA by $80,000. So example 3 is we work on the operations. So we work on those intangibles. So we start with that same $580,000 EBITDA, but we worked on those intangibles. So now our multiple is a 7. So now the company value is over $4 million. So an increase of $1.5 million by simply increasing the EBITDA by 80,000 and improving the intangibles or the operations. All right. So number 4 is kind of a tragic story because number 4 is one that the owner is really kind of busting his butt in the business. So it's got the highest EBITDA of $1 million, but because it's so dependent on that owner, the multiple in this example is only a 2. So that gives a company value of $2 million. So that is the lowest of our 4. Okay. Strategies for strengthening business value over time. So the key word here is time, and is time on your side. So from previous seminars, we realized that exit planning and value building is a process, and that process can take 3 to 5 years in advance. So the first step is to establish a baseline. So what we do is we do some sort of self-assessment and score what our A&R score is, or attractiveness and readiness. So how attractive is our business to a prospective buyer? So for this, we want to review our 4 C's, which are human capital, structural capital, social capital, and customer capital. Next is how ready is our business to sell? Is our company transferable? So if I were to buy your business, can I step into your shoes and the business run pretty seamless? Or do I step into your shoes and I lost 3/4 of my business? So the higher those score, the higher my multiple will be, the higher my value will be. All right, so now that we went through and identified areas that we need to improve on, it's time to pick 3 to 5 goals that we can accomplish in the next 90 days. So that's called a 90-day sprint. So when we get done with our 90 days, we're going to revisit those and say, hey, did we accomplish our goal? If the answer is no, maybe we need another 90 days. If the answer is yes, we pick the next 3 to 5 and work on that. So after a series of going through this a couple times, we're going to go on perhaps to the next step. So, but the first step involves picking goals that are to reduce risk. So we do this because this is the low-hanging fruit. This is kind of easier than the other one, and we want to build some momentum, something that we can see. After we've been through that a couple times, then we go to the next step, which is to increase value. All right, a little deeper dive into mitigating risk. So we talked about a bunch of this. This is kind of a summary, but the biggest one is going to be reduce owner dependence, because this is the biggest value killer in the business. So we do this by developing a strong management team. Next, we wanted to reduce concentrations, and this is going to be customer, which is the biggest one, supplier, or maybe even product lines. Improve process procedures. This goes back to documenting procedures, looking at those to improve those for efficiencies. Next, we want a history of clean financial statements. You like to see maybe 2-3 years in advance where the financial statements are pretty buttoned up and there's not a lot of discretionary expenses or questionable things that kind of erode that trust. Next is reduce legal exposure. We want to see, is there any disputes out there, maybe with customers or suppliers, maybe with the government. We want to make sure that's all wrapped up ahead of time. Make sure there's no warranty stuff that's not disclosed on the financial statements. If you have copyrights or patents, we want to make sure that's all up to date and filed. Next is to improve company culture. We like to see long-term happy employees. What we don't want to see is a lot of short-term disgruntled and a toxic workplace. So if we have, lack of skeletons, that's going to equate to a higher price. All right, so after we've been through a couple 90 days of mitigating the risk, we're on to increasing value. So probably the biggest thing you can do here is improve your EBITDA the right way. We can do this by increasing sales, decreasing expenses, being proactive and creating a good marketing plan rather than reactionary, creating models that have reoccurring revenue, maybe long-term contracts that make that income stream and flow a little more predictable. We went through the documenting process and procedures, and so what's that going to do is it's going to create maybe an easier path to opening up a new product line, or we can scale this and open a new business across town and have the blueprint to be able to do that. Exit-ready businesses often perform better today. So exit planning, value building, that's simply just good business strategy. As we're going through these 90-day sprints, hopefully we are seeing and realizing that the income statement is improving. As we're working on the operations, the multiple is improving, and something funny may happen along the way, and that is that a business owner may find out that, hey, I'm having fun in the business again. Maybe I built a strong management team and I'm not working in the business as much as I did before. So maybe I may decide I may keep this for a couple of years, or I may realize that I've increased the value of the company to get what I want today, and I can sell it for to who I want, when I want, and for how much I want. So we've went through a lot in the last 4 seminars. So if anybody has any questions, please feel free to reach out to me, to Nikki, to Nancy, or to Lee. So Lee, I'm going to hand it to you to take it away. Thank you.
All right, you guys, we'll get you guys some oxygen. That was a lot to cover in 30 minutes. As we thought, we don't have a lot of time for Q&A, but one of the things I guess I just kind of occurred to me, and I don't, Nikki, maybe this is more for you, is you talked about valuation and how to drive up that valuation. When should you actually do the valuation?
Yeah, so you should do the valuation. Really, that's like one of the first things that we do in the process of looking to sell. You might not need a full valuation. You might need a full valuation. Typically, you need those when it's going to be for the IRS or for some other purposes. But you can also do a calculation of value. It gets you to the same amount of work going over the numbers, but typically we want to do that when we start talking. So you might not be ready to sell yet. So you're like, why would we do the valuation already? Because you don't know what levers to pull until you know what that valuation is and you've gone through that process. Likely again, after you've made some adjustments, or if you've made some adjustments or time has passed, you'll get that valuation updated before you want to go into a transaction. So oftentimes you might have a couple cracks at it, or you might just want to sell right now, be ready to retire, and that would be one of the first things we'd do in the step towards that process.
Okay,
Yeah,
thank
Lee, I
you.
think it's one of the first steps, because I think a lot of times business owners may think that their business is worth a lot more than what it really is, right? So I think it's important to get that baseline and then to figure out, okay, well, this is a little bit lower than what I thought, but I have some time to increase that value, and then put the pedal to the metal and work on it for the next 3 to 5 or maybe 10 years to build that value to a point where it's high enough where you can retire and live the life that you want.
Right. Great. Thank you guys. That's super helpful. And thank you both so much for, I know a lot of work goes into that. Thank you for sharing all that expertise. And of course to Nancy as well, who was involved in the other ones in the other webinars in the series. I just want to mention everybody, if you found today's discussion helpful, if this kind of raises questions about your own business, we would, of course, welcome the opportunity to continue the conversation with you. So whether you're considering a formal valuation or planning for succession or evaluating shareholder transactions or look, just want to better understand how the value drivers of your business, we are here to help. If you are already an SVA client, please reach out to your SVA professional or your SVA advisor. If you're new to SVA or not currently a client, feel free to contact any one of our speakers or, of course, me, and we will connect you with the right SVA person here. You can also visit svaccountants.com for additional articles, webinars, business resources, our past webinars as well, all sorts of fun information there. So please seek that out. And I just want to thank you all for spending part of your day with us. And of course, to those of you who've attended the past webinars in the series, thank you for hanging with us. Hopefully you enjoyed the process. We really appreciate your time and hope you found today and the other sessions very valuable. That's all for today. Thanks, Craig and Nikki, and we wish you all a very wonderful afternoon. Bye-bye.